Hello there. This is Mr. Chime from weeklybagel.com. I am back again with another episode of the Weekly Bagel podcast. And today I am going to be explaining credit score to you. If you had listened to the last episode of the Weekly Bagel podcast, that was an intro to credit building. And on that episode, I did like a summary of what having credit is all about, building credit, and maintaining good credit throughout your working class life. And the reason why this is very important is due to the fact that in the United States of America, credit is king for most young working class adults. Now, I know you might be like, oh, cash is king. Oh, yes, cash is king for those that have money. If you are a young working class adult that is struggling to make it, that has not saved up to 5 years of living expenses, and you're struggling to stay afloat and you're still trying to figure it out, credit is king to you. This is because most things here in the United States, for you to be able to afford certain comforts like transportation, having your own car, you need to have a very good credit history, and you need to have a good credit score to have access to loans that we finance these comforts that I mentioned. So that intro to credit building, which was on the last episode, was me kind of warming you up for what is coming. And today I am just going to go ahead and explain credit score to you. So that way you know how important it is to you and what you can actually do with a very good credit score. First of all, before I begin, I would like us to define what is a credit score. You have probably heard about credit scores. Oh, my credit score is good. Oh, my credit score is bad. And then you go to get a loan and the banks are asking, oh, what is your credit score? And that there is a determinant of how comfortable your adult life is going to be. This is especially if you're a young working class adult that is making enough just to pay rent. Even if you are making enough to still have some savings, there are certain things here in the States that you cannot afford without getting it financed. One of them is a house. Because for you to be able to pay cash for that house, that means you're going to have at least $250,000 in cash. And I can tell you that even I, Mr. Chime, do not have that amount as I'm talking to you right now. And that is the case of most young working class adults out there. Hence, why credit score, having a good credit score and a credit history is quite important. So what is a credit score? Well, it's just a 3-digit number that tells banks and people that give out loan how likely you are to pay back the money. So a credit score is basically a 3-digit number that ranges from 300 to 850 that tells any loaner or any lender that you could give back any amount that you borrow from them, that you are going to be able to make your monthly payment on time, that when you borrow from them, that you will not renegade on any payment arrangement that you all come to. And to simplify what a credit score is, it's just basically what determines your ability to borrow money and pay it back in a timely manner. Also, I can also say to you that a bad credit score always, to bankers and lenders, reflect your inability to pay back loans or to pay back your debts. You might be making a lot of money. Say you might be making $100,000, or more, and you might have a big amount of savings in your bank account. If you have a bad credit score, it's basically telling any person that you're going to go borrow money from. I'm talking about banks and credit card companies or people that finance purchases, that you have a history of not paying back the debt on time, or you have a history of renegading on monthly payments towards a debt. So that's what a credit score is. Think of it as a trust score for borrowing. The higher you have it, the better your chances of getting something financed at a very good interest rate. So where does this number come from? Remember I told you it's a 3-digit number, right? And it ranges from 300 to 850, right? Well, here in the States, there are 5 factors that contribute to the credit ratings, which is also called a credit score. And these 5 things are your payment history, your credit utilization, the length of credit history, how many debts you have right now, and if you are trying to get more debts. Let me elaborate this for you. Well, your payment history contributes to about 35% of your credit score. Remember, credit scores are compiled by what is called a credit bureau, because here in the States, there are 3 credit bureaus. I don't know if you've heard about them. And they are called Equifax, Experian, and TransUnion. And what they do is when you borrow money from a bank or from a lender, every time you pay a certain amount of the money back to the lender reports to these 3 credit bureaus. And what these 3 credit bureaus do is they evaluate your ability to pay back that money. For instance, if you're making payments on time, they'll give you positive points to that. If you miss payments or if you're not paying on time, they will deduct points and give you negative points for that. So an accumulation of all these points is what constitutes your credit score, right? So your payment history, your ability to make payments towards a debt over a lengthy period of time, contributes to about 35% of your credit score. And by your payment history here, I'm talking about, did you actually pay on time? Like if you borrow a debt from a lender or a bank and your payment debt, your repayment of the debt every month is probably, say, on the 28th of every month, you're supposed to pay the money back, right? If you're not paying back exactly before or on the 28th of that month, you are likely going to get penalized, right? And whatever the penalty is going to be is going to affect 35% of your credit score. So payment history constitutes 35% of your credit score. Also, your credit utilization contributes to about 30%. What do I mean by credit utilization? Well, I mean how much of your available credit are you using? Let me give you an instance. So a while ago, I wrote an article on credit cards, maxing out credit cards, right? So whenever you get a credit card, you get a credit limit on a credit card. That's how much you could spend on that credit card. Sometimes some credit card companies might give you $3,000, right, on that credit card, and that's your maximum credit limit on that. Now, there is a rule on credit card usage where you are told to keep your usage under 30%. It's an unsaid rule, but banks and credit bureaus all know that. Like, say, if you're using 100% of that credit limit on that credit card, you can get penalized for that. I know you're eventually going to pay it back, but sometimes credit card companies will report to credit bureau, and credit bureau will penalize you for using all of your available credit on that credit card. So that's what I mean by credit utilization. Like if you are maxing out your credit cards, just bear in mind that credit card utilization is going to constitute about 30% of your credit score. When your lender eventually reports to a credit bureau that, hey, listen, this customer has already maxed out the credit limit that we gave him or her on the credit card, Whatever decision the credit card bureau is going to make, it's gonna that's gonna constitute you maxing out on that credit card constitute 30% of your credit score. The length of credit history, that is basically how long your accounts have been open, and that constitutes about 15% weight on your credit score. The longer you have of credit history, the better your credit score is going to be. This is why if two people go to a bank to borrow a loan and one person has like 10 years experience of borrowing and paying back on a timely manner, and the person makes about $30,000, right? And then another person has about 6 months of borrowing and paying back, and the person makes about $60,000, and they're all going for a $10,000 loan. Now the bank is more likely to consider the person with 10 years of credit history compared to the person that has 6 months or less of credit history. And the reason being that the person that has the longer length of credit history has already established himself or herself as someone that borrows and pays back on a timely manner. So banks lending that person money are not going to lose the money that they have loaned to this person because they know they're going to get it back. So length of credit history comprises of about 15% of your credit score. Also, if you have different kinds of debts, that's going to add to 10% to your credit score. And what I mean by this is, like, say if you have credit card debt and you have student loan debt and you have car loan debt, every month all these companies are going to be reporting to a credit bureau, right? And as they are reporting to a credit bureau, depending on how good you are at paying back the debt at a timely manner, the credit bureau are going to, evaluate your consistency and your ability to pay back this debt in a timely manner, and they'll be assigning points to it. And the points you're going to get from having these different kinds of debts is just going to be 10% of your overall credit score. So that's what I mean by credit mixing, or having a mixture of debts are going to contribute to 10% of your, they're going to contribute 10% to your credit score, I meant to say. Now, if you have been inquiring for new credit lines, take for instance, you have been applying for a lot of new credits recently, the weight on that credit score is going to be 10%. The weight of that on your credit score is going to be 10% because, credit bureau are going to evaluate why you're doing that, and they're going to decide to add 10% points to that or deduct 10% based on whether it's a negative inquiry or a positive inquiry. Now, that's all I wanted you to know about the 5 factors that contributes to your credit score. It's going to be your payment history, which is 35% weight, credit utilization, which is 30% weight, length of credit history, which is 15% weight, credit mix or mixture or having different debts, that's 10% weight, and then new credit inquiries, which is going to be 10%, right? Now, let's talk about the meat on the bone, and this is the credit score ranges, right? Now, before I talk about this, I want you to know that in the United States, there are 2 different credit score models being used. You have the FICO score and you have the Vantage credit score model. Now, your FICO score are usually used by banks and financial institutions. Like when you go to a bank or any other financial institution to get a loan or get something financed, banks will usually look up your FICO score, credit score model. And from that, they can assess whether you are going to be someone that they could give a loan to or not. Why the Vantage credit score model is basically used by apartments or small businesses when they want to assess your ability to pay back any debt. There is not much different from this, just that one is standard for the financial industry. That's the FICO score. That's the standard for financial industry. And the other is just used by any other business. And the best thing about it too is they have similar credit score ranges. And that's what I'm going to talk about today, credit score ranges. Now you have 5 credit score ranges. And these are classified as a number range, and the ratings are either being given as poor, fair, good, very good, and exceptional. And what this does for you is it determines the kind of interest rate you're going to get on your debt. What do I mean by this? Well, let me start by going with a poor credit score. A poor credit score has a range of 300 to 579. When you apply for a credit card or a loan, you are most likely to get denied because of this poor credit score. And even if you don't get denied, you are eventually going to end up paying a very high interest rate on the loan compared to people that have good or exceptional credit score. So before you even go get a loan, I usually advise young working class adults to make sure that they are out of the poor credit score range, because that's not going to do anything much for you other than bring you a high interest rate on your debts. Now the next one is fair. A fair credit score. A fair credit score has a range of 580 to 669, and you can get credit or loan with this kind of credit score range, but the terms of the loan is going to be worse. You're still going to get a high interest rate on this loan. Now when you have a good credit score has a range of 670 to 739. You're in a decent shape. What do I mean by you're in a decent shape? I mean that you are going to get approved for loans. As long as you have a job where you have income coming in monthly, you're going to get approved for loans. You're going to get approved for credit cards. You're going to get approved for apartments, because what this is showing is you have collected loans in the past, or you have acquired debt in the past and you have successfully paid them off on a timely manner. And interest rates on loans or credit cards that you get while you have a good credit score is going to be a decent interest rate. It's not going to be very high like the poor or fair credit score ranges. Now, when you have a very good credit score, you get serious solid rates. Take for instance, if you're trying to get a loan of $10,000 and someone that has a poor credit score, that is a poor credit score range of 300 to 579 goes for that, that person might get an interest rate of about 18% on that loan, right? Now, if you go with your very good credit score, which has a range of 740 to 799, you might end up getting an interest rate of 11%. I kid you not. The same goes with exceptional credit score. When you have an exceptional credit score range, which is the highest ranges that you have there, the range is 800 to 850. You're always going to get the best of interest rates. You're always going to get the best offers to you. In fact, if you have a very good income coming into that credit score range, that is exceptional credit score range, banks, lenders are going to be throwing themselves at you, because they know that they're going to make money off you and they're going to give you a very good interest rate, because they know that you pay all that money back and you always pay on time. So this is all I want you to know about the credit score range. Now, as a young working class adult, if you are going to have access to certain comforts, By access to certain comforts, I mean like being able to finance a car purchase, finance a college education, that is getting a student loan. You need to be at a good credit score range at least. What do I mean by this? I mean that your credit score has to be at least 670, so that when you go out there, you qualify for loans, you qualify for credit cards, I meant to say, and the interest rates that you're going to get on these are going to be very reasonable. Now, if you have checked your credit score and it's in a poor or fair credit score range, there are ways that you could build up your credit score to be in good, very good, or exceptional credit score ranges. And you could do this, like I mentioned in the last episode, that's the intro to building credit, that you could do that by going to your bank and tell your bank that you want a secured credit card. And a secure credit card is a credit card where you deposit money as collateral and then you use the card like a regular card and then you pay it off monthly. And then the bank is going to always report to a credit bureau, and if you're making their money, if you're paying back the debt at a timely manner, a credit card bureau is going to reward you with positive points. And month by month, your credit score is going to keep growing until it goes into a good credit score range. And before you know what is going on, it's either in a very good credit score range or you have an exceptional credit score range. If you want to use any other credit cards out there, I always recommend using the Chime Credit Card Builder. This is because it doesn't have any fees attached to it. So using it as a way of building your credit is quite recommended. In fact, you know what I'm going to do? I am going to attach a couple of articles that I wrote on these things here. After listening to this, just look at the articles so you can be guided into getting the best getting the best credit card that you need to have a very good credit score or a good credit score. Yes. Now, with respect to credit score, to sum this all up, it simply means just when you borrow money, pay it on time every time. If you have a minimum payment on the debt, make sure you're always paying it on time. You can either pay it before the due date or pay it exactly on the due date. Because if you wait after the due date, usually you may get penalized because your bank or whoever that loans you that money is going to report to a credit bureau and be like, hey, I loaned money to this person and they're not really paying me back my money. And the credit bureau are going to be, okay, well, this person is showing inconsistency. As a result, we are going to deduct points. And that will go into your credit history, right? So make sure that you are always paying on time and you are paying every single time. And you don't have late payments. The reason why I'm telling you this is because late payments can stay on your credit report for 7 years. My friend, when I say 7 years, I mean even after you have succeeded in getting your credit score to a good, very good or exceptional credit score range, and you go to get a loan and the lender runs a credit background check, they will see that late payment even though the debt is paid off. So this is why I am stressing on making sure that when you borrow a debt or when you have a credit card that you're spending on, make sure that you are paying the money on time. Never ever, at least try your very best as a young working class adult to never have a late payment on your history. This is because that's going to be on your record for 7 years, and after 7 years it falls off. But the thing is, within that 7 years, there's a high chance that you're going to go get another loan, right? You might be getting a loan to get a house or get another car, or sponsor yourself to acquire a college education. And if you have a history of late payments on there, whoever is going to lend you that money is going to charge you a high interest, because they will be like, okay, there's a high chance that I may not get my money back, so I might as well charge a high interest so I can make up that money that I gave to this person. So that's the whole point of it. Try to make sure that you pay your debt on time. That's how you build a good credit score and a good credit history. Now, there are some things that you do that might hurt your credit score, and that is, like I mentioned, late payments. You have missed payments too. Like, say you're supposed to pay on the 28th of this month and then you don't pay on the 28th of this month. Well, your lender is going to report to a credit bureau. A credit bureau is going to penalize you and record it on your credit report that you missed a payment on a debt, and that's going to be there for 7 years. And your credit points are going to drop, thereby affecting your overall credit score. Also, maxing out your credit cards affects your credit score. Remember when I talked about credit utilization and I mentioned that maxing out your credit cards can get you penalized? That's a thing, because credit card utilization constitutes about 30% of your credit score, right? So if you're maxing out your credit cards, even if you pay it off, the utilization is measured as a statement time. What do I mean by this? It tells whoever is inquiring into your credit report how financially responsible you are. Another thing is, if you have a credit card and you've already paid it off and you don't want to use it anymore, don't suddenly close it off. Because if you go and close off that account, there's a chance you might get penalized. You might get penalized by it. I've done that before. I once had an American Express credit card. This was about 8 years ago, and it's even funny. I tried to build my credit score, and after 8 months, after I've gotten the credit score that I wanted, I just went and shut down the account, and I was penalized. And you wouldn't believe this: 48 points were deducted from my overall credit score. When I asked what happened, they said, "Oh, you closed the account." I'm like, wow. So the main thing I would advise is just don't use the credit card anymore. You can have it shredded and you just let the credit card expire on its own. But don't try to close the account, because if you close the account, there's a high chance you might get penalized for it. Also, applying for multiple credit cards at short period of time could also affect your credit score. Yeah, because it might be telling the credit bureau that, hey, this person is not financially responsible. So they're going to be like, okay, well, you are applying within a space of 4 months. You already applied for 6 credit cards. And what does this mean? It also goes back to what I talk about credit utilization, right? You have multiple credit cards and you're spending more. And you're acquiring debts at a very fast rate. So obviously there are going to be things like missed payments, late payments, and all that. And as a result, points might be deducted from your credit score. Now, another thing that affects credit score might be when you go to your credit report, right, and you found out that there's an error on there. Now remember, compiling your credit reports are done by human beings, so sometimes there might be an error that may show up, and if you don't dispute the error, it's going to affect your credit score in a very negative way. In fact, let me tell you a story. I have disputed an error some time ago. This was in my mid-20s. I went to Credit Karma and I was looking through my credit report, and I found that somebody opened a credit card in my name somewhere in, I think, Kansas City, and I've never been to Kansas before. I was like, what on earth is going on? So I contacted Credit Karma and I was like, okay, I've never been to Kansas, and you guys made a credit report error, and I want it fixed right now. And they fixed it. But before that, that cost me some points on my credit score. But after they fixed it, within a few months, I was back to my regular credit score range, which is good. I know you might be thinking it's going to be exceptional, but mine is not exceptional. Yep, I'm just on a good credit score range. So, but yeah, be sure to always check your credit reports. If you don't know how to do that, I will attach a guide on this episode. You could go and read my article on that, and I'll walk you through how to check your credit score for free every year. Yeah, but that's basically what I want to talk to you about today about credit scores. This is all you need to know. On subsequent episodes, I will elaborate more on American credit score system or credit score model. So that way, you're gonna know everything that you need to know about this. So that when you're out there making financial decisions, that you are making it from a point or from a perspective where you're not gonna get screwed, and where you're not going to screw yourself. Because that's what I want for you. I don't want you messing up your credit history. I want you to always, when you go to collect a loan, that you're in good terms with the lender, and that you have an impeccable credit history. So that way you can be able to afford the comforts that you want to afford as a young working class adult. And that's all I want to talk to you today. So I know that there is an anxiety over credit score, credit history, and building credit in the United States. But it all boils down to just whenever you borrow debt, or whenever you acquire a debt, or loans, or a credit card, or whatever it is, any debt instrument that you get, just make sure that you're paying your debts on time, and you're doing that on a timely manner, that you don't have any late payment or mixed payments on your history. And that's how you're just going to build an impeccable credit score. Anyway, that's all I've got to talk to you about today. I remain yours faithfully, Mr. Chime. And as young working class adults that we are, we have to always make sure that we are in the best standing, that we build the foundation necessary for us to launch our ideal success. And that's what Weekly Bagel is here to help you out with. I am done talking for the day. I wish you a wonderful week ahead. Chime out.